Is your portfolio ready for what's next? Andrew Beer unveils how to tap into hedge fund strategies through managed futures, and Ronald-Peter Stoeferle predicts a golden run amidst a looming debt crisis. Meanwhile, Rhind assesses NVIDIA's explosive growth and its future in AI. Finally, Basmajian warns of an economic slowdown driven by housing market shifts. Don't miss these insights. Your financial future might depend on it. Today on Financial News in Review, we will summarize the following videos. From Taggart, Thoughtful Money, we have Tap into the Same Advantage That Hedge Funds Do, Andrew Beer. From David Lin, we have BS Warns of Debt Crisis, Gold to Rally 100% to $4,800, Ronald-Peter Stoeferle. From David Lin, we have How High Will NVIDIA Shares Go? CEO Jensen Huang sells 120,000 shares, will Rhind. From David Lin, we have Housing Supply Highest Since 2008, What's Next for Prices? Basmajian. Welcome back to Thoughtful Money, the channel where we unpack the mysteries of the financial world. Today, Taggart is graced by the presence of Andrew Beer, co-founder and managing member of DBI. In today's video, they delve into the often mystifying world of hedge funds and an intriguing category termed managed futures. Spoiler alert, it's not as scary as it sounds. Andrew Beer seeks to demystify managed futures and assert their value as an essential component of modern investment portfolios. He argues that managed futures, despite their arcane name, offer a unique advantage with low correlation to stocks and bonds and tend to perform best during tumultuous times. Andrew's mission? To bring hedge fund strategies to retail investors in a more accessible and cost-effective manner through his ETF DBMF. Here are the key points discussed by Andrew Beer. The concept of managed futures. Managed futures involve quant-based strategies that bet on trends across multiple markets, such as equities, rates, commodities, and currencies. These strategies are highly diversified and have no negative correlation to traditional investments like stocks and bonds. Performance in critical periods. Managed futures performed exceptionally well during crises such as the Great Financial Crisis, the dot-com crash, and 2022 when stocks and bonds both tumbled. In 2022, the average hedge fund in this space went up by 20%, even after fees. Accessibility and cost-effectiveness. DBI's ETF, DBMF, delivers these strategies at a significantly lower cost, 85 basis points compared to the traditional hedge fund's typical 300 basis points. The ETF model offers liquidity and accessibility, allowing investors to get invested with as little as $25. Evolution and democratization. The hedge fund industry's evolution has led to the democratization of previously exclusive financial strategies, making them more available and cost-effective for retail investors. Andrew likens DBI's mission to becoming the vanguard of hedge funds, focusing on making these strategies as efficient and impactful for everyday investors as they were for high-net-worth individuals. Andrew Beer made the following predictions. Shift to a new portfolio model. The traditional 60-40 portfolio is shifting toward a 50-30-20 model, where 20% could include diverse, alternative investments like managed futures. Future returns from equities and bonds are likely to be muted, making alternative strategies more critical. Managed futures becoming essential. Over the next 10 to 20 years, managed futures will shift from an optional to an essential component of robust investment portfolios. Their ability to perform in chaotic and unpredictable financial landscapes will drive this adoption. Andrew Beer wraps it up by emphasizing the immense value of diversification in smoothing the investor's journey through financial markets. He proclaims that managed futures provide an edge, particularly in volatile times, making them a must-consider for modern portfolios. Transforming hedge fund strategies into accessible and economically viable options for retail investors is not just a vision, it is becoming a reality. So why not add a bit of managed futures magic to your portfolio and sleep a little easier at night? Welcome back, gold enthusiasts. You're tuned into the David Lin channel, where today we're joined by the insightful Ronald-Peter Stoeferle. Ronald is the managing partner at Incrementum AG, and he's here to break down some jaw-dropping predictions for gold prices and talk about the recent Bank of International Settlements, BIS, warnings on a looming debt crisis. Ronald's not just a researcher, but also a fund manager, giving him a dual perspective that's as rich as the metal itself. Spoiler alert, he's bullish on gold, and he thinks it's got plenty of room to run. The core thesis of this video revolves around Ronald's bold predictions for gold prices amidst global economic turmoil. He argues that geopolitical tensions, recession risks, and shifting central bank policies are all set to drive gold prices sky high, potentially doubling by 2030. His views are shaped by his unique position in both analyzing market data and actively managing funds, providing a treasure trove of insights. Here are the key points discussed by Ronald-Peter Stoeferle, Gold Market Dynamics. Despite rising real interest rates, gold has hit new all-time highs, thanks to central banks buying more than 1,000 tons of gold in the last couple of years. Emerging markets now produce more than half of the world's GDP, and they are underestimating the importance of gold demand from these regions, notably China, India, and the Middle East. Predicted gold prices. Ronald forecasts that gold could hit $2,665 by the end of 2024 and a staggering $40,800 by 2030. Gold's role. He discusses the minimal allocation to gold in Western portfolios, suggesting an optimal allocation of 16 to 19% to maximize returns. Economic factors. A debt crisis, particularly in industrialized nations, could trigger a surge in gold prices. The BIS warns that rising government debt threatens financial stability. Ronald-Peter Stoeferle made the following predictions. Short-term gold price increase. Ronald predicts gold will hit $2,665 by the end of this year, 2024. He attributes this potential rally to unsaturated ETF demand and geopolitical or recession risks prompting more investment in gold. Long-term gold price. By 2030, gold prices could reach $4,800, driven by persistent inflation, geopolitical tensions, and a growing distrust in fiat currencies. Ronald concludes with a call to action for investors to seriously consider increasing their allocation to gold, given the many economic and geopolitical uncertainties ahead. He underscores the necessity of integrating gold into portfolios to hedge against potential crises and inflationary pressures. It's clear, folks, that whether we see it as a safe haven or a performance asset, gold is poised to shine. Welcome to the David Lin channel, where we dive deep into the latest trends in finance and investment. Today, David sits down with Will Rhind, the CEO of Granite Shares. We're discussing the future of tech, particularly the meteoric rise of NVIDIA and its potential trajectory. The video focuses on the sustainability of tech sector momentum, specifically examining NVIDIA's performance and potential. Rhind argues that the current tech boom, particularly led by companies like NVIDIA, is fundamentally driven by strong earnings and innovation, despite higher interest rates affecting other sectors. Here are the key points discussed by Will Rhind. Tech sector momentum. The tech sector's rise has primarily been fueled by earnings outperformance among major players, especially NVIDIA. Large tech companies seem largely immune to higher interest rates, unlike smaller companies that have struggled. NVIDIA's market leadership. NVIDIA briefly surpassed other giants to become the world's most valuable company by market cap. Upcoming earnings at the end of August will be crucial in setting future expectations. Earnings season and AI growth. NVIDIA's new chip releases and sustained demand for existing products contribute to its lead in the AI market. High investor interest in long positions on NVIDIA reflects optimism in its future prospects. Tech-specific ETFs. Granite Shares 2x Long NVIDIA ETF, NVDL, has become one of the most traded ETFs globally. Their NASDAQ Select Disruptor ETF, DURUP, captures the top 50 disruptive tech companies, even outperforming the S&P 500 without including the biggest names like NVIDIA. Will Rhind made the following predictions NVIDIA's continued growth. Despite brief market adjustments, NVIDIA's long-term growth is expected to persist, driven by AI advancements and earnings outperformance. The company's growth potential could even see it approach a $10 trillion market cap, though it's not without competition. Tech sector resilience. Large tech companies will continue to dominate despite broader market challenges, with strong fundamentals and earnings driving their growth. Rate cuts' potential impact. Future interest rate cuts could benefit smaller companies more, potentially broadening market performance. David Lin and Will Rhind wrap up the discussion on a high note, emphasizing the robust fundamentals driving the tech sector, particularly NVIDIA. Investors are advised to monitor upcoming earnings and stay informed about market sentiment. For those interested in tech ETFs, Granite Shares offers various options to consider. As always, stay tuned for more insights and updates on the David Lin channel. Hey there, market watchers. Welcome back to the engaging world of David Lin's channel. Today, we've got the one and only Eric Basmajian gracing us with his economic brilliance. If you missed last year's predictions, buckle up, because he's back with more juicy insights on where the housing market and the economy are heading. Eric, the brains behind EPB Research, is about to dish out some serious knowledge. Ready to dive in? Let's get rolling. Eric Basmajian returns to dissect the current state of the housing market and economy, delving deep into labor market trends, GDP growth, and the looming challenges in residential construction. Spoiler alert, it's a mixed bag of tight inventory here, swelling inventory there, and a cautious outlook on recession indicators. Here are the key points discussed by Eric Basmajian. Labor market trends. The unemployment rate has ticked up to 4% from last year's 3.4 to 3.5%. Job losses are concentrated in temporary help services, trucking, with manufacturing staying flat and residential construction surprisingly adding jobs. The residential construction sector's resilience hints at potential future job losses as inventory pressures mount. GDP growth U.S. Real GDP growth slowed down from 3.4% in Q4 2023 to 1.3% in Q1. Eric suggests stripping out volatile elements like inventory to focus on real final sales, revealing a weaker growth level. Housing market dynamics. The existing home market has tight inventory with a 3.7-month supply, while new constructions face a 9.3-month supply, highest since 2008. Factors such as high mortgage rates and the completion of previously under-construction homes contribute to the swelling inventory. Key indicators of a recession. The NBER's 6 variables for defining a recession show a mixed picture. Employment levels have peaked in some areas, but are still rising in others. Industrial production and real personal income have started to peak and decline, adding to the recession warning signals. Eric Basmajian made the following predictions. Economic deceleration. Eric foresees a continued slowdown in economic growth, with significant pressures stemming from the labor market and housing inventory dynamics. He emphasizes the vulnerability of the U.S. economy, especially if residential construction jobs start declining. Interest rate cuts. Given the current trajectory, Eric predicts that the Fed will need to cut interest rates more aggressively in the coming years to combat the economic slowdown. Eric Basmajian sums up the video with a cautious outlook on the economy. As the housing market moves towards looser inventory and more price pressure, particularly in new constructions, he advises a vigilant eye on residential construction employment and a cautious stance in investments. He encourages viewers to closely monitor the labor market and housing trends for signs of further economic deceleration. Stay tuned, stay sharp, and don't forget, when life gives you lemons, make sure the economy isn't hiding the lemonade. In this episode, Rhind remains bullish on NVIDIA, predicting its continued dominance fueled by AI and robust earnings, with future rate cuts potentially broadening market performance. Eric Basmajian cautions that while the housing market struggles with inventory pressures, the economy faces a potential slowdown and interest rate cuts loom ahead. Rhind and Eric Basmajian both underscore the impacts of interest rates on different sectors, but diverge in their focus: NVIDIA's tech leadership versus housing market risks. Continue tuning in for detailed insights and expert analysis. Thanks for watching Financial News in Review for July 7th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.